also as accounting rate of return. In simple words, we can say this as ARR. So average rate of return or as accounting rate of return. So last class we discussed about capital budgeting. Can anyone say what is meant by capital budgeting?
Yes, ma'am. Capital budgeting is mean by the forecasting the budget and according to our capital we are allocating and planning the budget list.
That is for capital funds. That is long-term funds. Long-term funds in the sense, can you give some examples for long-term funds? Loans. Okay, long-term loans. Any other long-term funds? Land.
Buildings, machineries.
So all these kinds of funds we can say that as long-term funds. Okay. So for those capital budgeting techniques, basically there are two kinds of techniques. Do you remember that? What are all the two techniques?
Discounting and non-discounting.
Very good. So one is discounting method, another one is
Non-discounting
method. So that discounting method is called as traditional method. Okay. And the non-discounting method is usually called as modern method. So under discounting, again there are different methods where we will be discussing that whether to fix the project or not. Okay. Do you remember what are all the different methods comes under the discounting concept? One is payback period. Okay. And next one is what we are going to discuss now, that is
Average rate of
return. So average rate of return is what a second method in capital budgeting techniques. And the meaning of this is, so this method takes into account the earnings from the investment over its whole life. See, whenever we are doing some investment for the business, the return that what we are getting from the business is actually, that is what a profit, right? So that is what a profit that actually we gain from the business. Even that is what the expectation of all the business owners. Okay. So here this method takes into consideration that how much return that you earned from that investment. Say for example, you invested around 10 lakhs for your business. How much return that you get back from that investment? Say for example, 10% or 12% or 15%, whatever may be the interest rate that you gained from that investment is actually called as ARR, average rate of return or accounting rate of return. So formula for this ARR is average annual profit after taxes divided by average investment. Okay. So average annual profits after taxes. See, profit, that is what the gains that you gained, every year. Okay. So that profit, it should be deducted from tax. That is why it is mentioned here as after taxes. Okay. So total profits divided by the number of years. Say for example, you may have different profits for different years, like say for example 5 years. So you should add all the 5 profits divided by 5 times. That is what average annual profits after taxes, after deducting from taxes, divided by average investment. Investment is what initial cost that you inserted for your business. Okay. So this is the formula. Again, average investment, again there are some different formula like cost minus scrap divided by 2 plus WC is working capital plus scrap. See, cost is the initial cost, initial investment. Okay. So I said, so 10 lakhs or 20 lakhs, whatever investment that you are willing to insert for your business, that is the cost. Minus scrap. See, we say this as scrap value or as salvage value, which means, see, the value of any asset when it comes to its end over its life period. So at that moment, that value is actually called as scrap value, resale value. Okay, so that is the meaning of this scrap or salvage or resale. Okay, and plus working capital is nothing but the additional working capital, if at all that is required for your business, you may include here, or else you just ignore. Okay, so this scrap as well as this working capital, if it is given in your problem alone, like it will be solving in the case in the formula, or else you simply ignore it. So this is the formula. And next is what we will be discussing about the merits and demerits of this ARR. So advantages, first one is it is easy to understand and calculate. So as I mentioned you already, this is the traditional method of evaluating your capital budgeting. So it is not that much complex compared to your non-discounting method. So all the calculation parts are it is what very easy for here to calculate your ARR. And next is it can be compared. Imagine that in front of you there are different projects A, B, C and D, where among all the different projects, by calculating your ARR, right? So the highest rate of return only you will be selecting. Say for example, A is getting around 10%, B is 12, C is 7 and D is 5. Which ARR that you will be selecting? Obviously highest rate of return, that is for B. Okay, so obviously it can be compared. By checking all the different projects, you check, okay, this project is in the high return that we can able to gain from this project. Obviously, you will be selecting that. And last merit is, it considers all the cash inflows. There are several cash inflows involved. Among that, you will be calculating profit, average profit and whatever. Okay. So, these are all the merit side of ARR. Coming to the demerits, disadvantages, first one is time value of money is